Good morning, everyone. We are watching a live daily market outlook for Monday, 23rd of April 2012, prepared by Windsor Brokers. The week starts again driven by politicals as the euro and sterling came under pressure on opening, with euro opening with the gap lower last night from Asian session and accelerating reversal at the beginning of European session. So far dipped to 131.60 of last Friday's high at 132.23 as the markets digest the French first round of presidential elections result, which saw the President Sarkozy come second to Socialist François Hollande. Euro draws limited support from decision to double the IMF's war chest and might be kept in the check ahead of a debt auction in Italy, while political risk could weigh also with the Netherlands now facing new elections after the collapse of budget cut talks. Starting with the Netherlands, that is now the top news for today. The Netherlands, as a core Eurozone member, was drawn into Europe's debt crisis at the weekend when the government failed to agree on budget cuts, making elections almost unavoidable and casting doubt on its support for future Eurozone measures. The Prime Minister, whose centre-right coalition has been in power since October 2012, said on Saturday that crucial talks on budget cuts had collapsed after his allies refused to do a deal and that the new elections are now inevitable. But uncertainty over the makeup of a new government and wanting voters' support for bailouts and austerity measures raised question over Dutch backing for a fiscal responsibility pact seen as crucial to helping Europe cope with its debt crisis. From the Eurozone, also the global finance chiefs pressed Europe in weekend talks to quickly put in place the economic reforms needed to finally extinguish its debt crisis now that newly increased financial buffers have bought some precious time. A day after advanced and emerging countries agreed to double the firepower of the International Monetary Fund to help contain the crisis, the IMF's governing panel said on Saturday that the 17-nation euro area must cut government debt burdens further, push bold economic reforms and stabilize financial systems. Debt problems will resurface and growth will stumble unless these steps are taken. The head of IMF's governing panel, Singapore's finance minister, warned. An uneasy calm returned to world financial markets after the Greek crisis subsided, but the IMF is concerned that without strong action, fresh tensions will erupt, sapping the global growth. The euro area, the world's second largest economic bloc, already has slipped into a mild recession, weakening its major export partner, China, and other parts of emerging Asia, while growth in the United States still remains sluggish. As said, the euro came under pressure of the opening of the day. The sterling is also against dollar moving lower, lost its 161 support, while the dollar yen seems to be losing traction again after being unable to clear the trendline resistance and currently heading towards 81. Some recovery is seen on the dollar Swiss, however, still a trendline barrier at around 81.50 zone needs to be cleared in order to sustain the current recovery of last week's low. The stronger move was seen in gold just recently as the yellow metal dipped so far towards the 1630 zone of 1642 last traded a couple of minutes ago. moving again off the recent very calm and very narrow range trading and turning the focus again lower. We're going to follow up with the news of gold as it just started collapsing. We'll see during our presentation what news will be coming to see the more reasons. However, as said in our previous sessions, gold remains under the negative, with the trading within the negative outlook, and the pressure is more towards the downside. And more of this we'll see on our technical part that will follow up in a couple of minutes. Brief look at today's calendars. As China's flash manufacturing PMI was released during the night, 49.1 is the release, and this is the 2 months high of the PMI. There was no forecast for today, but 48.3 was the previous release. The manufacturing, China's manufacturing purchasing managers index still remains in the contractionary territory in April, but recorded the reading of 49.1 versus the set 48.3 in the previous month, and this marks a fresh 2-month high. Important to say that still holding below 50. That is a borderline, and above this level indicates industry expansion, while the holding below this level is indicating that industry is still in the contracting mode. Further to come in a couple of minutes, series of PMIs from Europe, starting with Germany at 7:28 p.m. Forecast is 49 for today compared to 48.4, so further improvement in Germany. And the next one, I think there we have a mistake in this one. Pardon, there is no mistake. The German comes as flash manufacturing PMI for April, 49 forecast for today compared to 48.4, while German flash services PMI for April is forecasted 50.3 compared to 50.1 of the previous month, so improvement in the both PMIs is expected. Eurozone flash manufacturing PMI is due at 758. GMT also improvement seen for today's release. 48.2 is the forecast compared to 47.7 of the previous month. And the flash services PMI from Eurozone at the same time, 49.4 expected compared to 49.2 of the previous release. From Americas, only Canadian wholesale sales are due today at 12:30 GMT, and 0.5% increase is seen compared to -1 at -0.1% of the previous release of the month of January. Now we're going to take a look on the markets and see the latest movements as the markets became active at the beginning of European session. Starting with Euro, the latest rally of last Monday's low at 129.93 broke above previous high at 132.11 of 12th of April, and posted fresh one at 132.23. However, the pair was unable to clearly break higher and regain next barriers at 132.50 and 132.80 zone. With today's gap lower opening seen now pushing the pair in the corrective pullback, as hourly studies are losing traction and approaching their midlines. After the RSI hit last week, overbought zone currently is in the corrective mode. 4-hour studies are still holding positive, but signaling a corrective action that is already underway. Loss of the initial support at 131.70-60 zone has now been already broken, 131.55, with the seen so far with the test of 20 days exponential moving average on 4-hour chart now underway, ahead of 55 days one at 131.39. I would say the loss of 131.40 zone would be risky for the pair, as this also marks approximately 38.2% of the latest up leg, and it might turn the near-term focus lower and keep the upside intact. However, a reversal at above this level would be ideally seen as end of the corrective pullback and the open way for further expansion higher. Still the pair on the larger picture, we can see the pair is still moving within the range that is defined by 132.20 on the upside and 130 on the downside. 130.00 also marks beginning of very strong support zone that is defined by 130 on the upside and 129.50 on the downside. Fibonacci support level with the daily studies still in the negative territory, keeping the focus on the downside. The pair is currently testing the broken trend line of the drone of 142.46 October 2011 peak, and if break below will signal a false break above the trend line and turn the focus again lower, with loss of this critical support zone at 130.00, 129.50 to confirm the tops at 134.85 and the lower top at 133.84, and possibly to open way for fresh weakness. Immediate targets on the downside, 128.75, low of 2012 January, as well as January 2011, a very significant support ahead of possible revisit of the yearly low at 126.22 posted in mid-January 2012, seen in the short term on a break of 129.50 and 128.75. Sterling is still holding its strong uptrend of recent low of last week at 158.17. Just reminder, 158 zone offers very strong support, along with 158.40, where is the 200 days moving average. Positive structure continues to dominate on the lower time frames. However, overextended conditions on the 4-hour chart, as RSI is already emerging below the emerging out of the oversold overbought zone, might signal some corrective action preceding fresh rally. From Fibonacci levels of this movement, initial support comes along with the previous high at 160.61, which also marks approximately 23.6%, and just below this we have the 20 days moving average as dynamic support at 160.55. More significant would be the 160 zone, 160.18. We have the 138.2% retracement and the previous high at 159.84. So basically break below 160 and 159.80, where is the 50% retracement, and the 55 days exponential moving average would significantly weaken the structure and keep the upside intact for the time being, and possibly open lower levels for a test with 159.40 Fibonacci level and static support at 158.94 seen on the break. As said, the reversal above 160 would be seen as ideal one. Above 160, as we said, 160.40 would be seen as ideal for extension higher, with the upside the target, the key one seen at 161.64. This is the high of 31st of October 2011, and this also marks the 61.8 Fibonacci retracement of the broader down move from 167.45 high of 2011 to 152.33 low of 2012. And this comes as a very strong barrier at 161.64, 67. Daily studies are still pointing higher, and yet no any signal of reversal, keeping the upside in focus, with current pullback so far, according to the daily structure, seen as corrective. However, loss of previously mentioned the levels at 160.40 and the more significant 160.00, 159.80 would significantly weaken the short-term structure of cable. The dollar yen is heading south now, approaching 81.00 as it broke initial support at 81.16, also a low of 19th of April, also the previous range peak, keeping the upside for now intact as the recent recovery of 80.28 last week's low failed to regain the main bear trend line drawn of 84.08 high of 21st of March 2012, and subsequent weakness is now turning the focus lower break on the 4-hour 55 and 20 days moving averages, with the 20 days now started to point lower, and the possible break below 55 days one to signal that this will be the end of the corrective action of 80.28, and bring initial supports at 81.00 as round figure support ahead of 80.70, pardon, 80.70, 80.82, 80.70, loss of which is to open our initial support at 80.28. On the daily, studies are still negative, and the main focus remains on the downside as the pair is in corrective mode of 84.17. It's yearly peak posted on 15th of March 2012, with nearly 50% of the initial rally from 76 to 84.17 seen so far. 80.28 was the recent low posted last week, just ahead of 80.09 that marks 50% retracement, and 80.00 round figure support and low of 28 of February 2012. That will be our next target. Only break above last week's peak, last Friday's peak at 81.77, and before this 81.51, the trend line resistance would signal extension of the short-term corrective action of 80.28, and open levels at 82 and 82.50 next. For now, the outlook remains more negative as the hourly studies are firmly holding in the negative territory, and the hourly 20 days moving average already crossed below 55 days one. That keeps the focus at the downside. As said, the initial barrier and the strong barrier at 81.74, 77, where is the trend line, and the previous high keeps the upside protected for now, and only break above this level would improve the current picture. The dollar Swiss is in the near-term recovery mode of the recent low posted last Friday at 90.84. It's significant that the recent descent of 92.50 last week's peak after the pair broke above initial barrier at 92.21 was short-lived, as a subsequent steep reversal brought the pair back to the middle levels of its short-term range that is defined on the downside but by 90.90, and on the upside by 92.50. Last Friday's dip below the initial support at 90.90 seen a brief break to 90.84. Currently the bounce higher is still seen as corrective, as initial barrier at 91.20 zone has so far been taken out. Currently the price is attempting at 20 days moving average ahead of 55 days one at 91.46, and the trend line resistance at 91.60 zone, and basically only break above these levels is to ease the current bear pressure and keep the pair within the range. Significant barriers on the upside are at 92 and 92.10 zone, which marks the previous highs. Also 92.08 is the high of 18th of April, and 92.21 is the high of 5th of April 2012, and only break above as set trendline resistance at 91.60 before this the moving averages would bring these levels in focus. On the downside, 90.84 offers initial support, and the loss of this level would likely refocus a very strong support and the base at 90.00 zone. Studies on the daily chart remain still in the rather neutral mode as the trend is narrowing within the triangle, and immediate barrier is set triangle resistance at 91.84 and the triangle support at 90.56 would give more ideas about further direction of the pair. As mentioned at the beginning of the session, the gold is sharply lower at the beginning of the European session as it broke below its short-term, very narrow range movements. However, the larger picture still keeps the negative tone, and this was just an extension of the downtrend, broader downtrend of 1790. Peak of 29th of February. Currently the support at 1630, where is also the trend line support comes under pressure, break of which is to open next static support at 1612, low of 4th of April. Negative structure on the daily chart keeps the downside in focus with the break of 1612 and 1600 as round figure support to open way for further weakness and possible test of very strong support and double bottom at 1532, 1522. On the lower time frames, the studies on the hourly chart are sharply pointing down and with sharp fall below the midlines, now defining the negative tone in the hourly chart, while 4 hours one already holding below their midlines and keeping the downside in focus, as 20 days exponential moving average currently at 1644 cups the upside ahead of a recent range ceiling at 1657, and before this at 1648 is 55 days moving average capping any upside action for now, and basically only break above I would say 1660 would avert immediate risk of revisiting 1612 and the 10 focus slightly higher. And finally, brief look at the crude oil that remains within the trend of downside 102 and the upside at around 105, 50 directionless movement, showing also the 4-hour studies still in the rather neutral mode. However, loss of momentum sees currently more focus, and break below moving averages sees more focus towards the downside, and basically only break of 102 support is to open our next very significant support at 100.67, low of 10th of April, and $100 as a round figure and psychological support. Studies on the daily chart are still negative as the pair remains within the channel of 110.53 high of 1st of March 2012, keeping the upside so far protected at 105.50, where is also the channel resistance, and basically only, and also the 50% retracement of the recent down move that bottomed at 100.67. Basically only break above 105.50, 60 would provide the near-term relief and allow for stronger correction. Otherwise, immediate focus remains as set at 102 zone. Just above this is 90 days moving average at 102.44. Loss of these levels is to refocus 100.67 and $100 per barrel as next very strong support. That was all for Monday, 23rd of April 2012. I wish you a very nice day. We are back tomorrow at the same time at 7:00 GMT. Good luck.